Good afternoon, ladies and gentlemen, and welcome to the PCI PAL results presentation. To start with, if we could cover a couple of housekeeping items. Before we begin, we would like to submit the following poll, which you will see on your screens. Throughout this presentation, investors will be in listen-only mode. However, questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen, or if anyone has dialed in via pcipal@walbrookpr.com. The company may not be in a position to answer every question it receives today. However, the company will review all questions submitted and publish responses where appropriate. These will be available via your Investor Meet Company dashboard. Finally, we would like to remind you that this presentation is being recorded. I would now like to hand you over to Chief Executive James Barham and Chief Financial Officer Ryan Murray.
Thank you, Tom. Hello, everybody. Welcome to our FY25 update and walkthrough of the results and the look ahead. We've had a good week seeing investors this week. FY25 was a strong year for the business. We think we've got the right strategy. And that's really being seen now with the strength of various areas of the business, whether that be the cloud platform, the integrated partner ecosystem that we've got, and our international reach as well. So, those three core parts of our strategy that we've had for a number of years are really ringing true right now. So, yeah, a lot of good stuff going on in the business. Spending most of my time talking about new opportunities rather than fixing things, which I think doing my role is a great place to be. So yeah, enjoying life at PCI PAL, myself, but also my team at the moment. Ryan and I are actually in the same room. It may not look like it, but we are. So when I look across, that's what I'm looking at. So look, quick background today. We do quite a lot of these sorts of things. I'm trying to get out a bit more publicly as well. So please do pick up some of the content that's available on the Walbrook website. We now have recently initiated with Edison as well. We recently did an update video with them. So what I will do in this session is I will give an overview of the business to begin with, but I'm not going to do too much of a deep dive into the products that many of you know very well. But if you just go back to our interims presentation, there's a bit more background in there, but we want to leave enough time for questions as well, which can sometimes be where we run out of time. So with that in mind, let me start with some background on the business. So if you don't know us, PCI PAL is a fast-growing SaaS business. We have a secure payments platform that empowers our customers to transact business with consumers securely, to do it in a cost-efficient way, and to do it in a way that's compliant with the various data protection standards, particularly around credit and debit card payments. Our platform provides services across every single business communications environment. So what we mean by that is the examples would be live voice, web chat, social media, conversational AI, so voice bots, chat bots, all of these incorporated into the contact center mix, or as was known, the call center mix as it is today. So we cover everything that goes into the contact center, whether it be human or whether it be bot, which is something we're starting to see a little bit more of over time. Three key pillars to the strategy, which I touched on just in that opening. So we have cloud, so to be the leaders in cloud technology in our market. We were the first to market with a true public cloud offering in our space by a number of years. We have built the most extensive multi-tenanted global public cloud platform in our space. And you'll see as we go through this that it's in a very robust position as a cloud platform that supports our business. We use our cloud technology to be able to access the breadth of our market globally, and we're able to work with any size organization in the contact center market. So we work with the very largest contact centers, like in the UK, the Department for Work and Pensions and HMRC. And we work with many sort of smaller or mid-market end contact centers as well. And actually the contact center market by majority is that kind of commercial to mid-market end. So that's been, it's an important part of our run rate business quarter to quarter. And in order to access the breadth of that market, we leverage a channel go-to-market model. So we primarily sell through partners or resellers in our case, and a bit more on that to come in 1 or 2 slides time. Across our platform, we have more than 700 customers. We've got some fantastic brands who clearly are the ones that we put on the slide collateral. But it is often big brands that are looking to protect their data and are being the most innovative around payments and customer experience within contact centers as well. So a lot of great customers, and also you get some big brands who don't actually have very big contact centers either. So we do have expansion opportunities within many of our customers as well. And as I said, we service the breadth of that contact center market opportunity that we've got. And then just on the bottom right there, you can see the partner ecosystem, which is very important to this business. And we started out on partners very early, and we've been able to build a very strong ecosystem of integrated resellers as a result. And just yesterday, the new Gartner Magic Quadrant for CCaaS vendors was out, and PCI PAL is integrated to the vast majority of those, and certainly is integrated to the largest on that Gartner Magic Quadrant. So that's great to see. Right, some trading highlights for you. So not a huge amount that was new in terms of the key metrics that we hadn't already mentioned at the trading updates in July. But yeah, just to reiterate, ARR is our key growth metric within this business. We are a SaaS business. Everything we sell is on our public cloud platform. So we're growing ARR at 25% year on year into FY25. We're the fastest growing company in our market and have been for a number of years. And I'm pleased to see analysts showing us in peer groups on the financial research that's out there, and we appear to be either top or certainly in the top 3 of peer groups on AIM as well. So, and this is all organic growth. So very pleased with that performance in the year to get to the numbers we got to. Driving ARR is contracted ARR, which is another metric we use to measure our growth. The only difference between contracted ARR or CAR and ARR is that contracted ARR includes contracts that are not yet at revenue recognition. So we have a time to revenue before we get to that point. So actually our CAR is a good indicator of where our ARR is going to be in the next 6 to 12 months. For those that know us, we did change that metric, the name of it. It used to be called TACV. It was literally a brand change. There was no change to the definition. We just wanted to align it more closely to ARR, because in the future, as our time to revenue continues to reduce, it's likely that we won't need both. And so we're working towards that. Revenue up 25% in the year. Actually, you have to normalize that because we did have a double count of revenue from the audit issue that we had in FY24. So actually the normalized sort of trend under the surface that I look at is 17% in top line revenue growth. As I say, ARR is the key for us when we're considering growth. Strong retention supporting those revenue numbers. So GRR at north of 95%. It is tough in the SaaS market at the moment. So for us to maintain north of 95% GRR is top percentile performance. I'm very happy with that. The board are happy with that too. And it really does create an opportunity for us to do more with those customers that we're winning. We've proven that we are good at winning new business. Can we now prove over the coming years that we can sell more to our existing customers? And we need to make that available to our sales teams, to our customer success teams, to have more products to be able to sell, to be able to do that. And then just finally, profitable as expected in the period and in line with market forecasts. So all in all, just a more general summary of the business. I often talk about the health of the business, and that the business is super healthy right now. It's healthy in terms of our metrics that we're delivering. Our public cloud platform is seriously robust. The uptime's fantastic. Our relationships with our customers, high retention. Our relationships with our partners, that is in better state than I've ever seen. And it's not always perfect working with partners, it just can't be. But more on that to come. But we do a lot of work on that side of things, and we've got some very concrete relationships there. And then also the health within the business as well. The strong culture that we have at PCI Pal, it's so important to what we do. It's had to evolve a bit as we've grown. It really doesn't feel that long ago that we were sort of 5-6 million revenue. So we are now much larger than that. And I think we've been able to mature the culture without destroying it. And it's a very good position to be in. So we're very proud of that and what we've built. So ecosystem, I'll talk about that a bit more in a moment. The partner ecosystem, big highlight renewal in the year, really emphasizing our credibility in enterprise business, probably one of the largest PCI contact center contracts in Europe, possibly even globally, that we successfully re-tendered through a pretty competitive bidding process with everyone and anyone involved in our space and more. And we got some fantastic feedback. Actually contacted the customer about that, and we were told that we performed exceptionally well. So really pleased with my team for that renewal, which over the 6 years, if we retain it for the 3+3, which we would expect to, potentially north of 10 million in revenue from that contract alone. So that's great to see. We want to see more enterprise business in the future. Other highlight wins in the period, some good expansionary activity with a very well-known airline, one of the largest airlines in Europe. We signed a particularly large customer in the US, which is an HVAC, so air conditioning type vendor, which might not sound a particularly large business, but when you do that across the entirety of the US, it's a pretty large organization. And competitor displacements have continued. So a number of competitor displacements in the period. Mostly we see those in the UK, which tends to be the more mature market. More of our sales in the US tend to be greenfield, but we do have opportunities to displace competitors. In fact, the one I'm thinking of here that we highlighted was actually in Spain as well. So kind of proves out the benefits of having one or two heads in mainland Europe as well. So that language support that we've now got covering some of the key regions for us outside the UK in Europe, such as particularly Spain and France, are particularly interesting to us. We've been successful in the period in displacing a competitor. And then just finally, in the blue box in the bottom right there, so the FY26 strategy. We announced this in the trading update in July, so I'm not going to spend too much time on this. And there is actually a pre-recorded Investor Meet Company video where I go into more detail on this, plus the Edison video as well. So please feel free to do that if you are inclined to put yourself through listening to me again. But yeah, please do that. But we have issued a refresh or an update to our strategy. It's not a new strategy. As I said at the beginning, we think our strategy is the right one. Some of the decisions we have to make are about how hard we push, how fast or slow we go at things. And we have to consider that in the mix of everything else going on with the business, the fact that we're publicly listed, et cetera, et cetera. And so we went through an extensive process in the year. This is the first year without that patent litigation that we were dealing with. I had a new CFO come into place in October as well. And we told investors we were going to be doing this, and we made a pretty prudent decision in my mind. We had 4 million in cash sitting in the bank. We believe that the majority of investors in PCI Pal invested in us for our growth potential, and they invest in it as a growth company. And we want to keep the pace up. That's the personality of this business. That's how we feel that we operate best. And so we took a decision to make a cash investment of £1.5 million in FY26. We've got a commitment within the business not to take our low cash down particularly much at all. I mean, we're expecting to be pretty much cash flow neutral despite the investment across FY26. And of that 1.5 million, 2/3 of that are into marketing and product marketing, and 1/3 of that is into product and engineering. The reason that only 1 million of it feeds through into the P&L in FY26 is because that's the marketing spend. Because the engineering expenditure is mainly R&D that gets capitalized over a period of time. The trade-off for that is that we're committing to try very hard to ensure organic growth in the region of 18 to 20% ARR growth for the next 3 years plus. We expect to do these things over the next couple of years anyway, but we want to sustain that as we take this business up to 30 million plus in revenue, because we've got a view of where we want to get to in the next 5 years organically. So yeah, we're very pleased about the decision, and we've actioned it, and we're now moving fast to make those investments so we can hopefully see the benefits of them later this year. But all in all, exciting time at PCI Pal. Partner ecosystem update. Pull this slide forward a bit from the last one we did, because it really is so important to us. Actually, the top 2 areas of this slide here are really kind of background information. So again, you can get that from previous presentations that I've made. But typically speaking, 70 to 80% of our business, our new business contracts, come through resellers. And those resellers generally come from the top 2 categories at the top there, integrated partners or solution providers. The majority of that just tends to come from integrated partners. Actually, in FY25, we had 82% of contracts coming through partners, and 68% of the value came through partners. Now, that's not unexpected for us at all, because when we sell direct, it tends to be of a slightly larger average size. So we're quite happy with that, though we have, over the last couple of years, seen that proportionate value that's coming through resellers increase and go up. And that's because we're getting in deeper with these partners, and partners are trusting us more to work with their enterprise customers. And so, we will try to do more of that as we go. And in fact, our strategy with direct business as well is that we will often look to see whether we can fulfill it through a partner, because we're very committed to our partner model, and that will help to the longevity of that partner relationship. Just in terms of the highlights, so in the bottom right there, the bullet points that you can see, a few highlights of the year in terms of partners. I said about the health of the business, the partner relationships that we have with all our key partners are in really good state. We never go across a full year and things pan out exactly as we expect them to with our partners in terms of how we forecast on a partner by partner, region by region basis. But we operate very, very closely within the business. We keep super close to how those relationships are going with partners, and we're able to fix things often before they become problems. And we're going into FY26 with the ecosystem, particularly key partners, in a really good state of play. And so that growth trajectory going forwards, we have the ecosystem as it is. We expect it to at least stay the same and then grow incrementally what we do with the partners that are in that ecosystem. We then look to layer on 1 or 2 new strategic partners every 6 months. And then those strategic partners will layer on top of what the ecosystem has already been producing, which incrementally allows us to sell more going forwards. Speaking of new partners, in the year we signed RingCentral. That was the kind of big news in terms of new strategic partners in the period. RingCentral in the past have done some work with competitors of ours, nothing particularly deep. They've completely standardized with PCI Pal, and we went through, in fact, the best bit of this story really is that we managed to get them to full launch within about 4.5 months, which actually, from signing a partner of that size, which is an organization that perhaps turns over $2 billion, to integrating to full launch across Europe and North America, for us was a real success. You only have to look at some of our Zoom announcements in the year before. I'm not telling you any secrets around this, but Zoom was more like, I think, 8 or 9 months, the gap between when we started the work to when we deployed. And an element of that is partner side, but an element of it is also how we're standardizing more of what we do, and a bit more on standardization to come. But yeah, very excited about RingCentral going forward. Good momentum into Q4, and we've signed a number of deals with them already in this Q1, which has started pretty well for us. We did sign another CCaaS, UCaaS player in the US as well, who is unnamed at this point. So we're not at a position where we are able to name them in this forum, but hopefully later, certainly later this financial year, maybe later this calendar year, we'll be able to name them. It's another $1 billion plus revenue organization in the US that is standardizing and focusing on PCI PAL. So that one will be a slightly slower burn to get up to speed, but exciting reseller partnership nonetheless, and just sort of proving that, you know, when these opportunities come up with these big communications vendors, they are coming to PCI PAL, and if they're not, we're being successful through competitive processes. I mentioned Zoom there. The reason I update you is because it tends to be one I've been asked about the most, so getting ahead of perhaps other questions. As some of you know, Zoom moved a bit slower than we wanted it to in the first full year that we had with Zoom, but we've seen really encouraging progress in the second half of the year, particularly in Q4. And in fact, this Q1, so just a month or so ago, we signed our largest deal to date with Zoom. Why has Zoom been a slower start for us than we had anticipated? I think it's purely that it's a very competitive space in the CCaaS market, and Zoom, as they would admit themselves, they're a large organization, but their CCaaS product is still relatively new, as is proved by the Gartner Magic Quadrant yesterday, where Zoom appeared on it for just the first time. Whereas we've got partners that have been on that Gartner Magic Quadrant for 10 years plus. So, you know, Zoom is having to aggressively go after market share, and we have a fantastic relationship with them, and we've got a very tight product working relationship. So as they do gain market share, which they inevitably will, based on the investments they're making and their capability, we are there and we will look to benefit from that as a key partner of theirs. And then finally, I'm just going to talk a little bit about conversational AI for a moment. So clearly, conversational AI is a big topic in contact centers. So this is voice bots and chat bots. It's something we're completely embracing. I think it's a really exciting thing that's happening with the contact center market. And to be clear, we see conversational AI as part of the contact center mix. So whether an agent is a human agent or a bot, it's within the contact center in our mind. Today, we're seeing very few payments going through conversational AI. We have customers using our services in voice and chat bots. That's come about as a result of some early stage reseller partnerships that we have. One of those is listed on the slide, so Poly AI. A number of our partners resell other conversational AI platforms, and as a result of that, we've integrated with those platforms via our partners already. So, for example, Cognigy is one of those. So we're becoming very well positioned with some of the vendors that are looking like taking the lead in this space as a result of our connectivity and strength in the CCaaS market, because that's actually where a lot of the conversational AI piece is going to play out. It's across the CCaaS market, and that's one of the reasons why we think we're exceptionally well positioned. There are a lot of these vendors, though, conversational AI vendors, and some of them are very small. You know, some of these largest ones I'm talking about, you're talking 20, 30, 40 million revenue. So they're the largest in the space. The smaller ones are very small. And so one of the challenges we have is that we want to be able to serve the mass market across conversational AI, but how can we do that in a cost-efficient way? And so we were talking to investors at the half year to let you know that we were working on a conversational AI API. We now have that API available, and it is now active out there in the market. And we have customers on it as well. The conversational AI API allows us to give a standardized, more out-of-the-box version of our click-to-pay, speak-to-pay, and key-to-pay solutions that conversational AI vendors can gain access to. And we can be relatively hands-off to them doing it. And then we can leave them to just bill and use the services as they go. But the volumes are so low at the moment, we're really not talking about any material revenues. Our main focus is to position ourselves for the long term, which I think we are doing very well right now in terms of what we're doing here. So, and we really want to reserve, you know, custom work, real strategic work to the larger potential conversational AI partners, in the same way that we do for our CCaaS partners. If you haven't read it, in the CEO statement, we spent some time talking about the value proposition for conversational AI vendors with PCI PAL, and so I won't take you all through that now, but I think that is worth a read. And you'll see that the value prop for conversational AI vendors is actually very similar to our CCaaS vendors, and you can see where PCI PAL sits in that mix. So we think long term we have an opportunity here, particularly because it is fully expected by technology analysts and people that know the industry that conversations will increase as a result of conversational AI. You have people interacting with bots within contact centers who historically would never have spoken to a bot, would never have spoken to a contact center, excuse me. So you're actually going to see more conversations going in. And we think particularly that's going to happen around voice AI, actually, as it becomes more sophisticated. But today, we're not seeing any sort of immediate impacts in our near-term pipelines or renewals or anything like that. We are more so getting ready for the future, and we're going to be exceptionally well positioned for that. So I said I was going to canter through some of the background product pieces. I do have something on platform in a moment. So different types of payments that we cover: agent assisted, fully automated more so today would be bots, but historically was IVR, so auto attendance, these sorts of services. The three key products that we sell to our customers and make up the vast majority of our revenue today: click to pay, key to pay, and speak to pay, I've spoken to. Now let's talk about our platform for a moment. So the PCI PAL platform is a public cloud platform within Amazon Web Services, available globally across numerous different instances. And it's entirely integrated to the partner ecosystem that is summarized at the bottom of that slide there. Across leading CRM and desktop environments, so we've got connectors into all of those vendors. We integrate to more than 130 payment service providers, and we are still adding them month to month. And we've got more and more efficient ways to do that. So we effectively can aggregate across all these payment providers. And then additionally to that, we are resold by some of the world's leading business communications platforms who are facilitating a lot of these conversations going on. So we think from a platform perspective, we're very well positioned. Our secure payment suite, as you can see from the orange semicircle there, is available to all customers across the partner ecosystem. And we expect to continue to grow that. We are still seeing very strong demand for our core products. We are, though, intending to broaden our value proposition. We are not doing that because we see an erosion in demand for our core products. No, we expect to continue driving that forward, and those core products will contribute to the growth, the mid-term growth by majority that we see over the next 2 to 3 years. But we do want to broaden our value proposition. And as a result of that, we've been talking to investors, explaining that we plan to launch adjacent products. And one of the reasons we want to do this is we want to generate more new business from existing customers, because we've got great relationships with customers. We've always had strong customer retention. So we should be able to sell them more, because we can sell really well when we're selling new logo and we have products to do that with. So part of this is about capitalizing on the high retention we've got and to drive that NRR metric north. And, you know, we have a 3-year ambition, or I certainly do, to get that to 110% plus. So to really start moving the needle on NRR from adjacent products perspective. Now we have the launch of the fraud screen product that we announced in July, and that's the first in a range of adjacent products that we plan to launch over the next 2 years. The key areas of focus, you can see the emerging growth space there, the proactive fraud management piece, that's already out there, and we have the fraud screen product in place now with the view to try to reduce chargebacks within our customers' contact center environments. We're also looking at identity and verification. You know, we've been talking about this for a while, it shouldn't be too new. So this is ID verification, things like digital images of driving licenses, passports, these sorts of things. Customer authentication, so using solutions such as voice biometrics to, in a really sophisticated way, authenticate your customer. Now, our strategy around these adjacent products is product partnering, and we've illustrated that or evidenced that in the fraud management suite, where we're working with a large Belgian company called TeleSign, who have extensive fraud management capabilities across a good proportion of the world's mobile phone networks. And the reason we're doing this is because we want to move quickly. So our IP is how we make these things available within contact centers, completely integrated to those environments. We also think that fraud, identity, customer authentication is going to become even more relevant in a conversational AI world, particularly in the voice space. Because as conversational AI on the voice side becomes more sophisticated, so will fraudsters. So actually, we think there's an opportunity there, which is a slight sideways step from payments and more related to fraud and security. But this is where we're focused, and we're aiming to be able to update investors later this financial year with the next step that we take towards that. What's important for us when we're launching a new adjacent product, and we will launch other features and things, we talked about data analytics, for example, but they don't necessarily move the needle. We want to leverage our existing product positioning with our partners. We want to leverage our existing go-to-market model with any of these products that we produce. This is our strength. And we want to be able to do that from our cloud platform as well, so to keep it neat and tidy within the same platform. And we have to tick all those boxes, in my view, for any adjacent products that we're producing, or certainly we intend to over the next financial year. So in short, we want to capitalize on the position that we've built. Okay, so that's my operating update and background. I will now hand over to our CFO, Ryan Murray, for a financial run through, and I'll control the slides.
Super, thank you, James. Just highlighting that, following on from the strong year that we've delivered, with revenue growing to 25%, ultimately delivered a gross profit of just over 20 million. So that was up 26%, which is great. We retained our high, strong gross margins as we still drive towards the 90%. So we're at 89.5% for the year, which was very pleasing. But with that profit, we continue to reinvest that into key areas in the business. Driving partner management, as we said, we have a really strong partner network, and by expanding into other regions as we have in EMEA, pleasingly that's already beginning to deliver returns for us in the current financial year. So that's investing in, and also the fact that a large part of our new business comes from our partners. So we want to ensure we continue investing in that area, and ultimately driving new business, because we're good at winning and we want to continue good at winning, continue that. But once we win, also deployments, which I'll talk a little bit more about when I go into our ARR. But all of this investment is really to continue deepening our relationships with our partners, with our customers, and really underpin our future growth. Following that investment, we still delivered a really strong EBIT in the year, up to 2.3 million, and a full year pre-tax profit of 800,000. So the first full year we delivered profit right down to the profit before tax, which is very pleasing. If we have a look now at our ARR, if you look back over the last 5 years, the group has consistently, the compounded growth rate for our ARR delivery is really strong at 37%. That has been driven by, that demonstrates the stickiness of our revenue and also the reliability of our offering. So once we're deployed and we're with customers, they stick with us because we actually continue to deliver a really strong quality product for them. And you will notice actually we had a nice acceleration in our deployments in FY25 compared to FY24. And that's because we, as a business, we've started to focus on, the processes of our deployment and the standardization of that. And that's something we will continue to do. But I would also say that not all of the deployment is within PCI's control. There is, because of the deployment element, there is still a dependency on our customers. But we continue to work on that to streamline this as much as possible. And going forward, other years, we want to continue to maintain the ARR growth in the region of 18 to 20% going forward. But the ARR gets delivered from ultimately our contracted annual recurring revenue. And the contracted revenue is all the contracts that are signed but aren't yet live. Like, this will grow at a different rate to our ARR deployment, because this is the building blocks where the new business comes in, and we continue to add to that steadily year on year. So over the last 5 years, 25% compounding growth. But we're up 16% this year, and we want to make sure we continue that and increase that in absolute terms over the coming years to ensure that we can continue to deliver the ARR growth that we want to. But ultimately, we have a strong pipeline, which really gives us good visibility on our future CAR, and actually then the secure CAR gives us strong visibility over our future revenues. Yeah. Having a closer look at our revenues, it's really pleasing to see that within that, the recurring element has increased up to 91% from 89% in the prior year. So this really demonstrates the quality of our revenue, and it's being driven from our cloud solution, and the non-recurring element is remaining pretty static. So that's really important for us, that is the key drive, and again underpins the visibility of our future revenues and continued growth. Also, pleasingly, we've continued to expand in all our regions. EMEA, being our largest region that we're in, continues to experience really strong growth in the period, with the demand from our customers, either through, again, winning new customers or winning from competitors. North America, a really strong growth, 27%. And as James pointed out, that's mostly from greenfield sites, which really means that we're selling the value proposition to the customers in that region. I will also highlight ANZ is an important region for us, smaller in absolute terms, at about 500,000, but again experiencing strong growth in the year, over 25%. All of that has been flowing through to our adjusted EBITDA trajectory, which you can see that has been pleasingly moving in the right direction, and we continue to drive that EBITDA to 2.3 million in the current year. And that is a balance between growing our revenue and investing in the business. And we want to continue to invest in the business to ensure that profitability for the long term continues, and it's something that we will be doing through FY26. To support the investment in the business, we have a strong balance sheet. We continue to invest in our software to make sure it's the most up-to-date and most performant that we can be. We've also, in the first time, done an initial deferred tax asset recognition, which really underpins that actually the trajectory of the group in the direction of taxable profits. So therefore, profitability is what we're expecting to continue to see in the future. Cash at 3.9 million, slightly down on prior year, but that is simply due to timing of customer payments in H2 of the year. But we extended our banking facility with HSBC out to 2027, more for flexibility and liquidity should it be required, but actually we're projecting our cash to be cash neutral for the year. Say in the current year, we were cash generating from our operating activities, and we expect that to continue to grow going forward. And even next year, when we look to invest over the full year, we expect to be cash flow neutral for the period. But all in all, a really strong position to project forward for our future growth. Thank you, James.
Okay, thank you, Ryan. Back to me before we get to questions. So I spoke about the platform bit. Something I didn't talk about a huge amount is the uptime of the platform. So we've consistently been able to report north of 5 nines uptime. So that means the platform globally is up and available 99.999% of the time plus. It's not uncommon for us to have quarters where we are 100% up. That's top percentile SaaS performance when you compare that to similar sorts of size SaaS companies, particularly handling communications in many respects. So that's really very strong. And our CTO, our engineering team have done a fantastic job to maintain that, which gives me slight nerves whenever I talk about uptime, because you always never know what's going to happen tomorrow. But yeah, really good. Other sort of platform product update highlights. Trying to let investors know that actually maintaining the partner ecosystem in the way that it is, and the integrations that we have, fantastic as they are pretty deep with these partners. And so they take a fair amount of work for us to maintain those full integrations that we have. So we've constantly, across our engineering roadmap, got various lines which are working with existing partners to either, create new integrations to new products that they've got. They might have a new desktop, new single pane of glass, and they want PCI Pal to be part of that. And we have to keep doing these things, and we do need resource to do that. To keep working with our partners. Now that's the downside to it. The upside far outweighs that, which is that as we go through these cycles with partners, we get deeper and deeper embedded into their product. We build stronger and stronger relationships on the product and engineering side of the business. And we often call it our competitive moat in the business. And so, the vast majority of our key partners solely work with PCI Pal, or certainly PCI Pal is the preferred if we're not the only one they work with. And we'll continue to make sure that that's the case. We've completely majored on that. But yeah, a fair amount of work goes into that. It's not a case of just signing them, onboarding, and off you go. There is a fair amount of engineering work that goes on in the background to maintain that, but it does protect us, because our partners are less likely to, even if we were doing a bad job, to want to go and speak to somebody else. We are more efficient though when we are onboarding new partners, and I talked about Ring Central, and I mentioned earlier standardization, and I said I'd come back to it, so I'm coming back to it now. So top right box there, you've got standardization. We've been talking about standardization a little bit over the last 12 months. So this, in more simple terms, is where we are trying to make what we do a little bit more out of the box, as you would have said. So we want our key to pay, click to pay, speak to pay, payment gateway integrations, desktop integrations. We want it to be more standardized. In some aspects, we want it to be more API led. And we've been making progress along that path. The ultimate ambition for us over the next, we're probably only a year or so out from this, is for certainly those 3 current key products today to be completely available digitally through our website. So customers can sign up to them through our website, be deployed and go live through our website. That's the building blocks we're moving towards. But also that standardization helps us across the business. Even if we're working with a big partner that we have more of a custom working arrangement, because as we make things more standardized in terms of what we do, it makes us more efficient in everything that we do across the business, particularly when we're working with third parties, whether that's customers or direct. So longer term with standardization, it will also contribute to time to revenue reducing. So we're expecting to see time to revenue, which is around 5 months at the end of FY25, come down further in FY26, and it will get to a point where we don't need to be reporting our contracted ARR and our ARR as different things. We can just bring them together. The only reason we report on those 2 things is because traditionally we had a much larger gap. I remember the days we had a 9-month gap. Well, our gap today is half that, and we expect actually to move quite quickly towards halving it again over the next 12 to 24 months. So that's good progress from the engineering team on that side of things. Fair amount of work going on with data within the business at the moment. I won't get too bogged down on the topic, but single source of truth is a bit of a buzz phrase that businesses are using at the moment. But we want to have all of our data available to us centrally in one place. We want all of our systems interconnected within PCI Pal so we can be optimally efficient as we use data across the business. We want to be able to use AI to its full extent within the business. So let alone working with conversational AI vendors or coming up with AI features or enhancements to our own products. We want to be able to use and leverage AI within the business to maximize cost efficiency, drive more sales, all sorts of things that it can bring benefits to us for. Now, we are doing that already, like many organizations, but if you've got full control of your data, then clearly you can be even more efficient from an AI perspective, because data is key. One of the advancements we've made is with the data analytics capability that we've added to our reporting module. I mean, that's not going to move the needle in terms of material new products. That's where the adjacent products come into play. I would say this is more of a, new business win or retention feature, but it's a good enhancement that we're able to make because of the availability of data and our reporting capabilities. Good progress in the year across the product roadmap, which in terms of bright, shiny new things culminated in the fraud offering being launched. A number of enhancements across our partners who themselves have launched new products as well. I mentioned earlier about several of our partners launching their own conversational AI products. And so we've completed integrations with those during the period as well. And I mentioned the voice and chatbot API already, so I won't cover that in any detail again. And then just to wrap up, current trading and outlook. As I said at the beginning, trading for PCI Pal is very good right now. I always complain about starting a year with a July and August, but I inherited that. It can be a slower start to the year, but we've not really seen that this year. It's been a very busy July and August at PCI Pal. Pipelines are good, not just in terms of new business, but also new strategic partners as well. We're very targeted in the organisations that we go after. And we've made a good start, and excited to see what comes out of the product roadmap up to the end of H1 and then into the start of H2 as well. So good time to be at the business. Really feels like we're moving into a new phase with the company. So thanks for listening, and we've left plenty of time for some questions. Now I'm going to handle those. Facilitate, not going to answer them all necessarily. So we did have some submitted in advance as well. So let's try and get through these. One of these questions, I think we've already dealt with part of this. Did you have any partners that underperformed in FY25? I think I've covered that some partners you get up, some partners you get down, and you work through those things with the partners. You identify what the issue was, and you try and move forward with it. And we've gone into the year with all our key partners in good shape. The other part of the question was, do you have concentration risk? We don't have a single partner in fact, phrase that another way, all of our key partners are sub 10% of our revenue. So we don't have concentration risk. And as we're adding more strategic partners into the mix as well, you can see that that's not substantial. We do have one or two partners that have the potential to be a bit more concentration risk by nature of their customer base of their own. Those that have the very largest contact centers. There are some whale-sized deals out there, but if that comes our way, then so be it. It may create a little bit of concentration risk, but nothing substantive by any means. The acquisition. Next question. The acquisitions that the board were running the rule over, were they along the same lines as CNP, which is cardholder not present product, and other future offerings? So M&A has come up a few times to us recently. What I would say is that we put M&A on investors' radar. We didn't really say that we were heavily being proactive to go after M&A. We have to consider it given the size of the organisation we are now, and the board believe it's a strategic tool that we have available to us, just like anything else strategically as well. But we've got a good platform for it, the team, the culture, everything else. But we do need to be extremely cautious about it, given the optics of the market today. And so we're also aware, and myself and Ryan are acutely aware of how how distracting that can be within. Yes, we've grown a lot, but we're still a 20-25 million pound turnover company, so we're still relatively small. So it can be quite distracting. So we'd be super cautious around it. the main focus, if we did look at it, would be strategic product opportunities, but I can tell you that we're not spending any real time proactively looking at that at the moment. But it's something that we have available to us, and it's something that we should consider if we think so. But nothing really proactive around that. Sorry, some of these are quite long. I've listened to the interview I'll summarise. Listened to the interview with James with Edison, where he talked about Rule of 40 being difficult for a growing company. Summarising, there are many software companies delivering significant growth profitably. And I think one of the key points which is hindering a better share price performance is why a company which has now scale can't be more profitable. So it's really questioning a comment that apparently I made on the Edison interview about Rule of 40. I think perhaps I misstated that. And what I would say is that we're given our size and given our inflection points, I feel that we're very sensitive to the Rule of 40. So if we decide to invest what really is not a huge amount of money, if you consider some of the private equity money going into some businesses or venture capital going inside of businesses, we're investing another $1.5 million. That can push back our Rule of 40 ambitions somewhat. And so we do become quite sensitive to that. What I will say is that Rule of 40 is a metric that we measure internally. It's in our own internal forecast of when we expect to get to that place. I do know that when we look at the peer group on AIM, that PCI Pal is one of the fastest growing organically. There are very few ahead of us. There are others ahead of us who are growing through acquisitions, but we're talking purely organically. So I think we're doing a lot of things right in terms of Rule of 40. Our aim is we'd like on the current plan to be hitting Rule of 40 again within getting to that within about 3 years' time. Is broadly where we would expect to get that based on the current trajectory, but that's very much based on that plan. There's a question here been asked about us departing CISO, which I will summarise. It's a very long question. The last CISO, PCI Pal appointed a new CISO in August and never mentioned it. The last CISO, Jeff Forsyth, has been with the company for 26 years. Why no thank you for the number of years service as CISO at the time of the change in August? Why didn't the chairman thank him like he has Jason Starr? So I will deal with this question because there's a sort of air of I don't know, it kind of goes against our culture a bit really. So I want to make sure that this comes across in the right way. It's quite low level, but Jeff and I have a very good relationship. He was thanked publicly in my quote in the CEO report or on the front page of the accounts. And, this was the most impactful time to do it. Doing a standalone RNS reach to announce the retirement of somebody that's not on the board and actually not in the SLT is not considered appropriate within the business. I think what matters more to Jeff, and I know some of you know him quite well from patent case and stuff like that, is how personally I thanked him and how the business has thanked him over time. Do bear in mind, we've had a very good transitionary period with Royston coming in as well. Jeff is still on a consulting contract with us. We've got his retirement meal just next week, actually, which I arranged personally. So please don't be under any illusions that Jeff has not left on his retirement without our huge thanks. He was been an incredibly valuable part of the business. Even the business before, which made up a lot of that 26 years. Right, so acquisitions, how are we getting on? I think there's any more in the chat. Yes, we'll take this question. So there's a question in the chat, which I read when you were talking, Ryan, so I'll summarise it, which is, it's effectively asking that isn't PCI Pal's unique proposition that it joins calls, it breaks into a call at the point that there's a payment and therefore is able to isolate the payment data at the point that a payment is required. And so therefore, if that's not a human involved in the payment, i.e. a human agent, and you actually have a bot involved, that PCI Pal's value proposition is not relevant at that point. Probably the easiest way for me to respond to that is to say that a voice bot is really not much different to an IVR. So this is an interactive voice response system. So this is press 1 for this, press 2 for that. It's just far more sophisticated and intelligent. And we've been providing, and it's very relevant to IVR systems, secure payment systems to IVR. So whether it's an agent involved or an IVR, PCI Pal is entirely relevant. And the reason we're relevant, and I would draw your attention to the value proposition that we summarised for conversational AI vendors in the CEO section of the report, is because we take the environment completely out of scope. Actually, the human agent is the least of the worries of the contact centre in that business. Yeah, a human agent can really steal very few card details. When it comes to card data security, it's more about that data that goes into the systems where it gets sent. It's in the network, it's on the keyboard, it's going all over the place. That's more the concern. And so actually a conversational AI platform has the same issue as a C-class platform. It has the same issue as a contact center. So hopefully that answers the question. Okay, and then the final one here is, I've been a shareholder for a long time. You've performed very well and are now showing profit for the first time. I'm surprised that the share price is not higher. Can you get more coverage in the financial press? We're actually, this has been a bit topical really, but we plan to be as proactive as we can be over this financial year. You may have noticed that from the trading update that went out. We're trying to get more analyst coverage going. Although I'm very cautious to a degree to assess what the results are of that, because it's very time consuming, particularly for myself and Ryan. And does it move the needle? So you will see that we're investing more time in that. We've got a few investor events coming up as well that we're going to be doing. But if we don't see return on that time investment that we're making, then we need to assess that against the time that could be spent running the business and beating our numbers. And that is ultimately critically what we need to be doing, I think, to move the price forward. So the best thing we can do is make the business deliver, right? So hopefully that clears that one up. So I think that's all for the questions today, Tom.
Yeah, great. Okay, super. Thank you, James. Thank you, Ryan. Could I ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback. If anyone has further questions or would like additional information on PCI Pal, please do get in touch via pcipal@walbrookpr.com. Many thanks for attending today's presentation, and thank you again to the presenters.
Thank you, Tom. Thank you, everybody.